Hello everyone, and welcome to today's market update. Let's start with a look at Wall Street last night. The three major indexes ended the session virtually flat, with the Nasdaq closing at 25,818.69, the S&P 500 at 7,503.85, and the Dow at 52,925.15, all with near 0% changes. The market is clearly in a wait-and-see mode ahead of key economic data and geopolitical risks. However, futures trading before the bell sent a clear signal of risk aversion. Nasdaq futures fell 0.84%, S&P futures dropped 0.57%, and Dow futures declined 0.81%, indicating that tonight's U.S. market open will likely face downward pressure. Stock performance was mixed. Nvidia rose 0.53% to $196.93, and MicroStrategy gained 2.15% to $97.36, showing that structural buying remains in AI and digital assets. But Tesla fell 0.22% to $402.90, aligning with the broader risk-off sentiment. Now let's turn to the global macro picture. The yield on the 10-year U.S. Treasury note rose to 4.57%, a single-day increase of 0.84%. Investors are selling off treasuries, reflecting growing concerns about inflation and the upcoming CPI data. The VIX Volatility Index surged to 17.50, up 8.49%, and hit an intraday high of 18.90 within 24 hours. Market sentiment has quickly climbed from the lower end of the normal range of 15 to 25 into the middle, approaching the caution zone. The main driver is escalating geopolitical conflict in the Middle East, with border clashes between Israel and Hezbollah. The US dollar index stood at 101.20, edging up 0.13%, which puts marginal pressure on emerging markets but has not yet triggered a systemic shock. Oil prices jumped significantly. WTI crude rose 2.07% to $73.93 per barrel, and Brent crude gained 2.2% to $77.95, as geopolitical risk premiums were directly priced into energy prices. Interestingly, spot gold fell 1.21% to $4,090, suggesting that are not flowing into gold but rather into oil and cash. This implies the market is pricing in a scenario of rising inflation combined with tightening liquidity. In summary, global markets are clearly in risk-off mode. This could ease if the VIX falls back below 16 and Nasdaq futures turn positive. Let's move on to the renminbi and external conditions for Chinese assets. The onshore dollar-yuan rate was 6.7889, while the offshore rate was 6.8066, with the spread narrowing. The renminbi exchange rate remains stable overall, with no signs of panic depreciation. The onshore renminbi has appreciated slightly recently, providing marginal support for foreign capital inflows into A shares, but it is not enough to reverse the overall trend. A new signal has emerged in US-China technology frictions. According to reports from Reuters and Bloomberg dated July 7 to 8, 2026, the Biden administration plans to tighten export restrictions on chip-making equipment to China as early as this week, targeting key equipment makers like ASML in the Netherlands and Tokyo Electron in Japan. This move will directly dampen risk appetite for the A-share semiconductor sector. Our sentiment forecast for today's A-share market open is lower. The combination of falling overseas futures, rising geopolitical risks, and expectations of technology controls will weigh on the opening. However, if northbound capital flows exceed 30 billion yuan in net buying within the first 30 minutes of trading, the decline could be limited, or the market might even turn positive. Looking specifically at the A-share market, the Shanghai Composite Index is likely to fluctuate with a downward bias today, testing the low point from March 28. The Chi-Next Index faces greater risks due to the direct impact of technology controls. For sector focus, we recommend energy and national defense. The Middle East conflict is pushing up oil prices, so the energy sector should remain strong today, and the defense sector also offers short-term trading opportunities. However, be cautious with the technology sector, especially semiconductor equipment and materials. With U.S. regulatory restrictions looming and individual stocks like AEHR and POET posting massive monthly declines, this sector is not suitable for bottom fishing in the short term. As for northbound capital, net outflows are likely today. A stronger dollar, rising treasury yields, and escalating geopolitical risks are all unfavorable for foreign capital inflows into emerging markets. Our core judgment for today is that geopolitical risks combined with technology controls are creating a double drag, pushing global markets into risk-off mode. For A shares, defense is the priority. Our probability assessment is 15% for an up day, 35% for a sideways day, and 50% for a down day. Our strategy is to take only small positions in high-conviction bottleneck stocks for observation. For example, HPS.A, the data center high-voltage transformer bottleneck stock, has maintained relative strength in a corrective market, and its bottleneck thesis continues to play out. But we recommend keeping a small position and waiting for the index to stabilize before adding. For holdings, 5802.T carries a dominant downside risk, with a monthly decline of 21.54%. We suggest cutting the position. Risk avoidance names include POET and AEHR, which have fallen 30.27% and 32.01% respectively. We also recommend cutting these positions to avoid accelerated downside in a corrective market for relatively weak stocks. That's all for today. Thank you for watching, and we'll see you tomorrow.